90% of beginners lose money in the stock market. Not because the market is fake. Not because rich people are controlling everything, and not because investing is too complicated. They lose money because they walk into the market with the wrong mindset. They think investing is supposed to be exciting, fast, easy, like a shortcut to becoming rich overnight. So they follow random tips, panic during crashes, buy stocks they don't understand, and quit the moment things go wrong. Meanwhile, the people quietly becoming wealthy? They're usually doing the opposite: simple habits, long-term thinking, patience. In this video, I'm going to show you the 5 biggest mistakes beginners make that destroy their money, and more importantly, exactly how to avoid them. If you understand these 5 lessons, you'll already be ahead of most people in the market. Because investing isn't about being smarter than everyone else. It's about avoiding stupid mistakes long enough for compounding to change your life. Mistake number 1, chasing hot tips. The first mistake beginners make: chasing hot tips. This is where most people lose money before they even understand what investing really is. Your friend tells you, "Bro, this stock is going to explode." A YouTube thumbnail says, "This AI stock will make millionaires by next year." A TikTok creator screams, "Last chance before it 10x's," and suddenly your emotions take over. You don't research the company. You don't understand the business. You don't even know how the company makes money. But you still invest because you're afraid of missing out, and that emotion right there, FOMO, has destroyed more beginner portfolios than market crashes ever will. Here's the problem. By the time a stock becomes viral on social media, the smart money is usually already leaving. The early investors bought quietly. The internet hears about it late. And beginners buy at the top. Then the stock crashes. And suddenly everyone says the market is a scam. No, the market punished emotional decisions. Listen carefully. If someone can convince you to buy a stock in 30 seconds, you probably shouldn't buy it. Real investing is boring. It's reading, learning, understanding businesses, being patient. That's why legendary investors like Warren Buffett became successful. Not because they chased hype, because they ignored it. Most beginners want excitement, but excitement is dangerous in investing. Casinos are exciting too. And casinos are built so that most people lose. The stock market rewards discipline, not dopamine. So before buying any investment, ask yourself one simple question. If social media disappeared tomorrow, would I still buy this stock? If the answer is no, don't touch it. Mistake number 2, trying to time the market. Mistake number 2, trying to time the market. This sounds smart in theory. People say things like, "I'll invest when the market crashes." "I'm waiting for the perfect entry. I'll buy after prices go lower." But here's what actually happens. The market drops, and fear takes over. Now they're too scared to invest. Then the market recovers, and prices go higher. Now they wait again, and years pass without taking action. The truth is brutal. Nobody can consistently predict the market. Not YouTubers, not influencers, not even professional fund managers most of the time. Yet beginners think they'll magically buy at the bottom and sell at the top. That almost never happens. In fact, studies show that missing just the 10 best days in the stock market over decades can cut your total returns nearly in half. Think about that. A few days can completely change your financial future. And the craziest part? Those best days often happen right after terrible crashes. Exactly when most people are too afraid to invest. That's why successful investors focus on consistency instead of prediction. They invest every month. Whether the market is up, down, scary, or exciting. Because time in the market matters more than timing the market. Imagine planting a tree. You don't dig it up every week to check if it's growing. You water it consistently. And over time, it becomes massive. Investing works the same way. The people who build wealth aren't the people making perfect predictions. They're the people who simply stayed invested long enough. Mistake number 3, checking your portfolio every day. Mistake number 3, checking your portfolio every single day. This one destroys people psychologically. When your investments go up 2%, you feel powerful, like a genius investor. Then the next day, the market drops 3. And suddenly you panic. You start imagining crashes, losses, disaster. So you sell, and usually you sell at the worst possible moment. Here's the reality. The stock market moves every day. Sometimes for logical reasons, sometimes for emotional reasons, sometimes for absolutely no reason at all. But beginners treat daily movement like it's life or death. Your brain is not designed to handle constant financial volatility, especially when your phone gives you updates every minute. Red numbers create stress. Green numbers create addiction. Both are dangerous. That's why many successful long-term investors barely check their portfolios. Because they understand something important. Short-term noise means almost nothing. Imagine this: if you bought a house for your family, would you panic because someone offered you a lower price tomorrow? No, because you bought it for the long term. Stocks should be treated the same way. But beginners turn investing into entertainment, refreshing charts every hour, watching candle patterns, obsessing over every tiny movement. And eventually emotions destroy their strategy. The less emotional you are, the better investor you become. Sometimes the smartest thing you can do is nothing. Not buying, not selling, just staying patient. Mistake number 4, ignoring fees. Mistake number 4, ignoring fees. This is one of the most dangerous mistakes because it looks harmless. A beginner sees a 2% fee and thinks, that's nothing. But over decades, that tiny percentage quietly steals a huge portion of your wealth. And most people never realize it. Here's why. Investing works through compounding. Your money grows, then that growth also grows. And over many years, the snowball becomes enormous. But fees compound too. Every year they slowly eat your returns, like termites destroying a house from the inside. Imagine investing $500 every month for 30 years. One investment charges 2% annually. Another charges almost nothing through low-cost index funds. The difference by retirement? Potentially hundreds of thousands, even over $1 million. That's life-changing money. All lost because of fees most beginners never bothered to understand. This is why low-cost index investing became so powerful. You don't need expensive managers constantly trading stocks. Most professionals don't even beat the market consistently over long periods anyway. Yet people still pay massive fees because expensive sounds smarter. Simple usually wins. Low-cost index funds, consistent investing, long-term patience. That combination has created more millionaires than chasing secret strategies ever will. The biggest financial mistakes are often silent. And fees are silent killers. Mistake number 5, waiting too long to start. Mistake number 5, waiting for the perfect time to start investing. This is probably the saddest mistake of all. Because the longer you wait, the more expensive that delay becomes. People say, I'll start when I make more money. I'll start next year. I'll invest after everything feels stable. But life never becomes perfectly stable. There will always be bills, stress, unexpected problems, excuses. And meanwhile, time keeps moving. Here's something most people don't understand. In investing, time is more important than amount. Someone who starts investing small at 22 often ends up wealthier than someone investing huge amounts starting at 35. Why? Because compounding needs time. Time is the secret weapon. Even small amounts become massive when given enough years. That's why starting early matters so much. Not because you're rich, but because time does most of the heavy lifting. Imagine 2 people. One starts investing at 22. The other waits until 32, same monthly investment, same returns. But the person who started earlier could end up with hundreds of thousands more, just because they started sooner. 10 years may not feel important today, but financially? 10 years can completely change your future. And here's the beautiful part. You don't need thousands of dollars to begin. You don't need perfect knowledge. You don't need to become a stock market expert overnight. You just need to start. Small investments done consistently are far more powerful than giant plans that never happen. The market rewards action, not perfection. The real fix: how smart investors actually win. So what's the solution? How do you avoid becoming part of the 90% that lose money? It's simpler than most people think. Step 1. Stop chasing individual hot stocks. Instead, focus on diversified index funds. You're not trying to gamble. You're trying to build wealth safely over decades. Step 2. Automate your investing. The less emotion involved, the better. Set automatic monthly contributions and let consistency do the work. Step 3. Think long-term. Not days. Not weeks. Years, decades. The stock market transfers money from impatient people to patient people. Step 4. Ignore financial noise. Most headlines are designed to trigger emotion. Fear sells. Panic gets clicks. But reacting emotionally usually leads to terrible decisions. And finally, step 5. Start now. Not next month. Not after watching 50 more videos. Not when you feel completely ready. Because nobody ever feels fully ready. Every wealthy investor was once a confused beginner. The difference is they started anyway. Remember this. Investing is not about becoming rich tomorrow. It's about creating freedom later. Freedom to choose how you live. Freedom from financial stress. Freedom to give your family a better future, that's the real goal. Not flashy profits. Not showing off online. Real freedom. Powerful closing. 90% of beginners lose money because they treat investing like a game. A game of predictions. Luck. Excitement. Quick money. But the stock market was never designed to reward impatience. It rewards discipline, consistency, patience, and emotional control. The people who quietly become wealthy usually aren't geniuses. They simply avoided the mistakes that destroy everyone else. So if you remember anything from this video, remember this. You do not need to be perfect to win in investing. You just need to avoid panic, avoid hype, avoid emotional decisions, and stay consistent long enough for compounding to work its magic. Your future self will thank you for the decisions you make today. Start small, stay patient, and think long term. Because the greatest investment you can make is giving your money enough time to grow. If you enjoyed this video, follow Future Finance Lab for more. I share powerful investing and money lessons every single day. And as always, this is not financial advice. Do your own research.